In December, our next guest said that investing in Spanish debt could look smart a year later, but this year's events have changed his mind dramatically. Paul Abberley helps manage $430 billion in assets as the CEO of Aviva Investors. He's joining us now from Washington, D.C. Paul, great to have you here on Street Smart. I mean, buying Spanish debt actually year to date has not been a bad trade, certainly considering what else we've seen happen in markets. Spanish bonds, when I was looking at them, 10 years were up about 5% year to date, so not too bad.
Yes, I think it's worked out reasonably well, but to be honest, not as well as I'd expected. And if I was revisiting that decision today, I'm not sure that's a position I would recommend.
Paul, what would you recommend now? Would it be staying away from Europe altogether, stocks, bonds, currencies?
No, I think with regard to Europe, the best position to be in is to be very defensive and careful, and that probably means German bonds. I think the big difference from a year ago when we saw Spanish bond yields move up is the decision taken to allow what in plain English is going to be a default on Greek debt. Because once you establish the principle that a Eurozone country might not have to pay back in full the amounts it's borrowed, then that clearly brings a big risk premium to all the European government markets, and that's of course what we've seen over the summer. And when you're making long-term investments in the interests of your clients, it's probably unwise if there is any chance of those government bonds not being repaid, and hence the decision today to focus more on admittedly the low-yielding German market rather than reaching for those high yields that are available in other Eurozone countries.
And Paul, you're investing globally at the moment. Where else do you see value and safety?
Well, I think in the recent last 10 days or so, we've seen a lot of signals suggesting that markets are moving into an area where they're more comfortable with risk. But I think that's very much a short-term opportunity, perhaps out for a month or so. Longer term, the weight of debt on the global economy is still going to be a terrible burden, and we're going to be running with a rucksack full of rocks, and it's going to be hard to go anywhere fast. So for the longer term, we would still recommend being relatively cautious, and that would mean emphasizing the better quality government bonds, and also perhaps stocks that have got an income yield. You know, there's a lot of the investors out there need some yield, given that the government bonds are not going to be giving a lot of that. And so the more defensive and high-yielding stocks would be the place to be. For growth, even though the volatility of the emerging market equities tends to be relatively high, we still believe that the long-term story behind the emerging world is strongly in place, and therefore for longer-term growth potential, the EM equity and bond markets continue to make good sense.
Paul, now you oversee $430 billion in assets under management, so it's hard to believe you have time to do much else given the volatility we've seen. But you are in D.C. actually as part of the UN's United Nations Environment Program Finance Initiative, and I wanted you to explain what that is exactly and how that fits in with Aviva.
Well, the UNEP Finance Initiative is a public-private partnership, and the real focus is on what do we need to do with the financial system to align it properly with the task of creating a sustainable economic model, and by that one that's fair across all sections of society and is also fair to future generations. I think the financial market crisis really showed that that's not working as it should do. So the Global Roundtable here in Washington this week is looking at ways in which the financial system could be able to work more effectively. From Aviva, we have a fairly narrow focus on this, and it's one that's again aligned with what we need to deliver to our clients. We want to make long-term investments. We want to move away from the short-termism which has bedeviled capital markets, and we want to have that long-term focus on companies' strategies. But you know, there's a problem there in that so many companies at the moment are not providing that long-term perspective on their strategy. In fact, you know, some of the best data providers out there are Bloomberg, and your colleagues reckon that probably only a quarter of the companies that they follow provide any sort of data, and then there's a shortfall. So what we're arguing for here in Washington this week is support for the idea that perhaps at the Rio summit next year we could get a convention where governments around the world would require companies to talk about what their long-term strategy is and how they view it as being sustainable. or if they don't have a long-term strategy, or if they think it doesn't matter, to explain why not. But we feel that sort of reporting will encourage investors to engage on those long-term factors which we think drive value for clients long-term, and also, crucially, align the financial system with the needs of a sustainable economic model.
All right, Paul, unfortunately, we have to leave it there. Would love to spend more time talking about that. And you are right that Bloomberg is very focused and sort of at the vanguard on issues related to sustainability. But good to see you. Thanks for joining us here at Street Smart. That was Paul Abberley, the CEO and Chief Investment Officer for Fixed Income at Aviva Investors.